The Indian market surged to an all-time high. We are worried about the expensive valuation. After nearly 20 months, the markets have reclaimed its previous peak, overcoming strong resistance at around 18,800 in Nifty. However, when the resistance is eventually broken, it now acts as a robust support. Should you sell now or should you hold on? Here are 7 data-driven points to consider. First, is the market overvalued and stretched? Sensex in October 2021 stood at about 62,000. The earnings per share of the 30 companies in the Sensex amounted to Rs 2001. In June 2023, despite the Sensex reclaiming the old peak, the earnings per share of the Sensex 30 companies has risen to 2,788 rupees. This represents an approximate 40% increase in the earnings in the past 20 months from these 30 companies. The Sensex is not at an all-time high when factored for the increased profits of the underlying companies. The biscuit packet is the same 10 rupees, but now we get additional more biscuits. The price of the Sensex, it is the same, but the value has increased or the cost has decreased. As per research, the Sensex or the Nifty hits a new all-time high every 18 to 20 months. So if you redeem every time we hit an all-time high, we are disrupting the compounding. Just because the market hits all-time high, it is not expensive. There will be a new all-time high again sometime in the future. Market is like our age. It keeps on going up, powered by the engine of corporate profits. Bad economic news, rising interest rates, wars, elections, anything can push the market down. If you're one of those people who wait for the best time or look for economic statistics or macro or graphs, trying to figure out what the stock market is going to do next, you're going to be wasting your time. No one can predict the stock market. You have to understand that the market falls about 10 to 15% every year. Once in 5 years, there's a major fall of 25%. This is very normal and the market eventually recovers. As Peter Lynch said, the human organ that is needed for success in investing is not brains, it is the stomach. Investor psychology is such that when Nifty was at 15,000, everyone were fearful as it was a new all-time high. Today, at 19,000, Nifty is again at an all-time high and everyone is fearful. Everyone wants Nifty to crash so that they can invest. If the market corrects, majority of people will not have the courage to invest, just as they did not have the courage at 15,000. Finally, markets will go up. They will wish the markets corrects again. This journey continues. Investing is a game of regret. You regret that the stocks you invested in did not go up, or you regret that you did not buy the stock that went up, or you did not buy enough, or not soon enough. Every way, market gives you a regret. Missing the best 20 days sets you back by 50% in return. Your return falls from 14% to 7%. The best days come just after the worst days. So you cannot time it. You have to stay invested to experience the full return. Markets can correct any time. So keep a cushion fund liquid to take advantage of such falls. Otherwise, stay invested if your goal is 5 years or beyond. If you had invested and you had held for any 5-year period in the past 20 years, there was almost no chance of making a negative return, as you can see here. If your money is required for a short-term goal, then you should take it out. If your goals are long-term, then remain invested so that you do not break compounding. Equity valuation index shows we are in the middle zone. We are not yet in the greed or extreme optimism, the red zone. We are not very cheap though in valuations. Carl Richards summarized this in one slide. In the short term, there may be many distractions and disruptions. One should rise above to harness the benefits of compounding over time. Consider the 10% capital gains tax on profits when you sell investments. If you want to re enter at lower levels, it would require the markets to decline first to offset the taxes before you get any gains out of re entry. We are approaching an election year and volatility is going to be very common. Asset allocation funds and balance advantage funds give an advantage in these times as they actively rebalance with no tax impact to the investor. I hope you like this video. Please do consider sharing it with your friends, like and subscribe to this channel.